The Hedgeless Horseman here. It's July 10th, 2023. I think it's been about a month since I did my last video. I personally haven't felt that much of a need to bring Copium because I think there's been quite a few juniors that are quite well off the bottoms, and I personally think we are in a bull market, and we might have been in a bull market since late last year actually, even though it's going super slow. Still there's quite a few juniors that are well off their 52-week lows. Like always, if you were just averaging down, I average up and down depending on what the market sentiment is. But if you do the dollar cost averaging thing, I buy as soon as I get any money. I just invest. I don't really care what the sentiment is for the sector overall, because I'm always fully invested. If I get money, I'll just buy the cheapest story of the ones I like, and I just do that over and over and over and over again. And if some story is incredibly cheap, or I do diligence. Maybe I find a new case that's cheap, which I don't own yet. So if I don't have any dry powder, I'll simply, sell a bit of whatever junior I think is a good story, and it's why I own it. But still, that it, is the least cheapest of the holdings I own, or maybe that, hey, okay, this new stock I'm buying or whatever, maybe it's mathematically undervalued, but it's a high risk high reward story, and I need to maybe lower my risk, so I might sell a bit of another high risk reward story, etc. Because at the end of the day, it doesn't matter what your one stock pick typically doesn't matter in the long run, or I should say, all that matters is your long-term portfolio returns, and to have strategies that you can to have a strategy, to have a sense of why you're selling and why you're buying, that can be repeated. So these are my sponsors. I'm not even sure that if all of these are my sponsors right now, but to give them a shout out. I did an interesting thing. I let ChatGTP rewrite some of Napoleon's maxims of war to investing. It was just a fun thing to do and see if, hey, maybe some are actually applicable. And I actually think some of these came out quite well. Morale, investing, confidence, and emotional resilience can be just as important, if not more so, than the actual financial resources one has. I would word that as, like now, for example, psychology and mental fortitude and all of that, staying power, is much more important than being a superior geologist or a expert on junior due diligence. That's my opinion. At sentiment levels like this, I'm as always using Bear Creek Mining as a proxy. We're up here, I guess, now. You don't need to have superior due diligence skills, in my opinion, at extreme lows like we're seeing right now. Even in my opinion, some of the dumbest people could easily beat some of the smartest people just by holding on and buying more when it's cheap. Like we know, if you invested only since this point in time. You have you haven't even seen the evidence of what this sector can do when the tide change. I've seen this here. I've seen it especially here. So since 2015, I've seen this sector absolutely rip in a short time period. Again, nothing really changed with the companies. They went down 50% and up hundreds of percent. Companies that I own didn't really change much fundamentally from here to here, but price could change 500%. Again, you can't really find that from a due diligence perspective, except for the fact that, hey, if you do due diligence enough to figure out that, hey, juniors down here, they're super cheap, I'm probably not making a mistake. That's pretty much it. And there was a few other ones. This one I like. In war, the simplest maneuvers are the best. This one I wholeheartedly believe, and I think this translation to investing is pretty good. Complexity often leads to mistakes and confusion. A simple, well-executed investment strategy is usually more effective than a complex one. I mean, I do stuff like here, for example, I'm playing around with, okay, what do I think the risk-adjusted value is for, some primarily high-risk, high-reward juniors out there. And then I just look at, well, what's the market cap right now? What's the price? Okay, how much, if this is somewhat of a okay estimation of the risk-adjusted value, then this is the upside to fair value. And of course, when I see numbers like this, and I don't think my risk-adjusted values are outrageous at all. So it's like, this is what I'm seeing. This is, okay, right now, let's say, I think I have maybe an expected 312% upside from buying Headwater at 30 cents. Or Fathom Nickel, I believe that the fair price for Fathom Nickel is 382% higher. And so on and so forth. Do I know that all of these are correct? Of course not. I mean, reality is reality. Mother Nature has not changed at all. But all we can do is try to guesstimate what we think Mother Nature will reveal and just apply some probabilities to that. And of course, if we're talking like blue sky scenarios, I mean, here I have also some, percent of blue sky success priced in. So, if it's like 5% priced in, it's like, blue sky scenario, it becomes a 20 bagger, and, at 2 it becomes a, what that would be like, I don't know, 50 bagger or whatever. 50 bagger. And so forth and so on. And of course, some are, I think, more risky than other ones. It's like, probable upsides like Dynasty Gold. Well, we know they drilled a monster of a hole recently. Do I think they will have some more good news releases, or do they drill, 73 meters of 8 grams per ton and they'll find nothing more? No, I think they will probably find something more. I just don't know if it will be a mine or not, but what is the chance priced in that they will have a mine? And I think I used like a 500 million market cap as a price. I mean, we know Great Bear, for example, or some other really good mines, they can easily sell for more than 500 million in Canada. So I don't think 500 million as a blue sky scenario is that outrageous at all, actually. I mean, if we go into a gold bull, no, I should say, when we go into a gold mining bull, maybe this blue sky number would be triple or whatever. And of course, the actual success fundamentals of the company could be even better than I thought. So I just used 500 million as a blue sky scenario in, a mediocre sentiment environment. Something like that, maybe actually slightly good. But if we go into any sort of mania, then all bets are off. Maybe a project that is actually worth 1 billion in economic value might trade at 2 billion or 3 billion. I mean, things just happen. Hence why we see stuff like this. Nothing to do with value, but they can sure rip when people want to buy. And of course, we would never be this low. The high quality juniors would never be as cheap as they are now if people were actually rational. And that I think ties into one quote I really like from Napoleon: never interrupt your enemy when he's making a mistake. People bitch and complain about the sector we're in right now, but it's like, if you bitch about it, that means you really hate the idea of getting abnormally large future returns. If this sector was rational, maybe it would trade well, I can't say fully rational, but much more rational. Maybe it would bounce somewhere along these lines. Let's say the middle here is actually the value of a company, and we're a trading sardine, and we're estimating, as the downslope is suggesting here, that we have some dilution, so the actual value is actually decreasing if they don't do much from other than pay the salaries of people, and they don't create much value. But then you will have swings like this in this interval, and the best kind of returns you could have on your dry powder would be like 65%. Before the market already figures out that, hey, this is overvalued, and then you have a 40% correction. From these levels here, obviously, it's absolutely insane how the market can reprice the same asset, pretty much the same assets, hundreds of percent, depending on that people have the urge to buy, and like, I mean, what we're doing down here, we're front running when the sellers have when the stupid money has sold all the shares they owned, and nobody that owns the shares now is willing to put in a sell order at prices that are lower than this. By definition, that's a bottom, because you will never see a sell order. There's no transaction to be made at a lower price, because theoretically every single owner of those shares, and none of them are willing to part ways with the ownership of the company at a cheaper level, meaning that they refuse to get paid so little for their shares, and then the only way it can go is up. And as many people should know, the fireworks doesn't happen, well, it can change quickly, like we saw here, 200% in Bear Creek Mining in, I don't know how short of a time frame this was, like 2 months. Just absolutely insane. 200% moves, that's enough. 200%, you would be happy if your portfolio did 200% over several years, or at least a few years. That's insane returns. Nothing to do with rationality. Just got overextended to the downside, ran out of sellers. All of a sudden, just a few buyers ran it up 200%. So that's gonna happen, and sooner or later, because the people on the streets are not gonna find out that the miners are doing well. I don't think this 200% pop here didn't get many people interested in the sector. These kinds of moves, or here's where people get interested in the sector, when they've seen a sustained, when the past is good, then they will believe that the future must always be good. So we're front running not only a bottom, so we of course should try to pick up as many undervalued, fire sale, ridiculous assets, well, prices, or assets selling at ridiculous prices as we can, and then sooner or later we're gonna start to have this could be the bottom. I personally think this is the bottom. I think we've been in a bull market for almost a year, but albeit a very slow bull market, meaning we're more or less grinding out the bottom, and then we have companies doing private placements, etc. But I think we might have seen the lows in the median junior already. But the masses will not get interested until they see headlines about how well miners are doing. So we're front running that. We're not only front running us going to maybe fair value, which might be up here. When we pass fair value, that's when the 90+% of people will actually start to get interested, because everybody wants to invest in a sector that is in a bull market, even though the big money is getting in when it's definitely in a bear market. And I've shown a couple of times that if you just drew a line like this, let's say I think the blue line here, for example, or even the black one, if you bought, in this case, Bear Creek Mining, bought it at this line here, for example, purple line, and you just bought all the way down, every single buy that was around the purple line would sooner or later return 100% in Bear Creek, and every single buy at a lower level would simply return more. 94%. Let's say you start buying here, and as it went lower, every single buy just provides higher and higher return. The lower it goes, the higher the future returns are. And now we're down here. Future expected returns are absolutely extraordinary. I mean, I know for my overall portfolio, it's kind of been treading water slightly up since the top here. But think about that. I mean, we haven't even begun getting into the good times. So our recency bias suggests that it's extremely hard to make money in this sector, because we've seen so many, for 3 years we've seen positive news not typically get rewarded that much, and even if we find a company that we think, this is absolutely absurdly cheap, even a monkey could see that this is way undervalued and that's going to be corrected, that might stay undervalued for 6 months, a year, more than that. So people start to believe that things will never change, and of course if you started investing here, you have only seen that side of this sector. So you will have to go on kind of faith and history to know that there's a reason this is called a cyclical sector. It's because it's been forever cyclical. That is the, if we're talking the simplest maneuvers are the best, complexity often leads to the single most important thing to understand about this sector, and especially now, is that this sector will forever go from overvalued to undervalued to overvalued to undervalued, simply because that's how humans act. Human psychology never changes, but human psychology is ever changing, if you know what I mean. Why we have these extreme rallies and extreme crashes is due to human behavior. And unless you think that the humans that are alive today and active in this sector, if they're not going to become anything other than human in the next, well, maybe even just the next several months or few years or whatever, we're gonna see a big rally one of these days. So what I mean by that is, like, let's say you started investing here and maybe you've done quite well, actually, relatively well. Let's say I think the GDX is down 36% or so, 33% over the last 3 years, and let's say you are down 36 or 40%. I mean, for a junior, that's pretty okay. I mean, if we just look at from the top here in Bear Creek, it was down 91%. So I mean, if you're down 50% right now, it's not outperforming GDXJ, but it might be outperforming actually the median junior from this top here. Let's say you're down 25% or 30 or 33 or whatever. That's not even a big pop to go back in the green. I mean, obviously from the bottom, let's see here, from the bottom here, that's 600%. That is just an insane, let's see here, you could be down 86% and you would break even within 8 months. I think you almost could be down. I was gonna say an infinite amount, but it's like if you're down 90% at the bottom like this, of course it sucks. But the good part about that is, if your portfolio is down 90%, you probably don't need much dry powder to actually significantly increase your exposure on the long side. So if you had $10,000 here and you're down to, let's say 1,000. Now let's say you have 10,000 here, it's down to 2,000. That's an 8,000% loss, or $8,000% loss. But with just $1,000 put in here, you would double or increase your exposure by 50%. So in that case, when we get back here, you'll actually, the $10,000 investor will become 10,000 again, and the $1,000 investment additional would become $5,000. So you would have at least 15,000 from my $11,000 invested. So even though it went nowhere, huge crash, huge rally, a relatively small sum of additional dry powder deployed around these levels will have you in the green, even if you just come back to the same place. But anyway, so I mean, if you're down, I don't know, 30-40%, like that's not a big in this sector. But I understand that if all you've seen is this kind of action in your portfolio for last 3 years, which is not I mean, in the grand scheme of things, yes, it's kind of a short time period because we've seen bear markets that's more than 3 years. But still, the most important thing is that we begin to believe that this is how the sector works. Because if you invested here, that's all you've seen. Disappointments, let's say, for 3 years. And you start to believe that that's how this sector always is. But that's just completely false, as is evidenced by this chart here. Or look up, Barron's gold mining index. There is not a single crash since that chart began, which is like 100 years ago or so, where miners went down forever, and they never went up forever. Hence the word cyclical sector. Just knowing this and acting on it, because like I've also showed a bunch of times before, there's a huge difference at extremes between buying, selling, and holding. Selling is obviously, you can't make worse mistakes than selling low. I mean, that's the most costly. Here you gave away 2,000% in what is that, like 2 years? No, 2,000% in 2 years. So a selling here cost you 2,000%. Selling here cost you 626%. Selling here or here, I don't know, 600% maybe. So that's the cost list. Holding obviously is infinitely better than selling, because if you, in this case, for example, if you rode this down but you didn't sell, you would get back to even. If you rode this down and sold, well, you just permanented the loss. Because down here, high future returns are much more likely than up here, much more likely than here. So the lower it goes, the higher the expected future return gets. So holding becomes better than selling for obvious reason, because you didn't sell a 500% future return opportunity. But what's better than holding? That's buying, which is orders of magnitude better than holding. So it's like I've been on vacation for over a week or so. It's like I'm not worried at all. My portfolio has actually done pretty well when I was on vacation, which I think is just another or more, I was going to say proof, but I can't really say that's proof because it's just like 1.5 weeks. But point is that I did one trade, I think, because I saw a company that was just so cheap. I owned a bit of it already, but I was just stunned that it had gone down like 40% in 1-2 weeks with no news. And I bought it at almost the lowest point that it's been trading at, and within 2 days I think it was up 58%. Now it's come down again, but still, that was the only thing that got me to be active. That I saw an opportunity, no news out, the company has cash, no bad news. Actually, things have gone relatively well, but there was a big liquidation taking place. So volume was huge. It dropped like 20% in a day, maybe 30-40% in 2 weeks or something. So that's, when people are making mistakes. I mean, should I be pissed about that? Sure, I already own shares of the company. So my paper losses there for a while were, I don't know, 60% maybe. But it wasn't a huge position. But I actually added, I think, because it became so cheap, so I could buy, I think, more shares than I already owned or something. For quite a small sum of money. So I think when that jumped 58%, I think I was already in the green on that stock. Moral of the story is that any stock is either overvalued or undervalued. If it has gone down and you're just bitching about it, then obviously you don't even realize, you can't even come to the conclusion if it's an opportunity or not. Because if I owned a company, put in $5,000 in a company, I thought it should be worth double what it was trading at. Let's say I put in $5,000 or $1 a share. I think it's worth $2. It goes down to 60 cents. Should you be pissed about that? Let's say nothing has changed. Should you be pissed about the fact that you lost 40% on paper? Or should you just see it for what it is? Like, I still believe this is going to be a $2 stock one day. Yes, I see that a paper loss now, which I think will turn into a paper profit, meaning I think it will go something like, yes, I bought it 1, I think it's worth 2. It went down to 60 cents, so I'm minus 40, but I do think it's going to go to $2 one day. So in the future, I expect to be up 100%. But at that point, when it's down to 60 cents, that's more than a 200% return in the future on dry powder deployed there. So again, is a crash in price good or bad? That depends totally on what you do. If you still think it's worth $2, you bought it at $1, and you sell it because it's gone down to 60 cents, just because you don't know if it's cheap or not all of a sudden, or you get scared, I mean, then the market won. They fooled you, they tricked you, you followed price. You totally forgot about price to value, which is the only thing that matters, really. So you just looked at one thing, you joined the herd, and you sold low. But there could be that stock, which you thought was, maybe your average stock you think is undervalued by 50%, so you think that, hey, 100% return in the future for my 20 stocks I own or whatever on average. If one of those stocks goes down 40%, and you think nothing has changed, it would obviously make sense that you actually sold some of the other ones that had not gone down, because now all of a sudden this stock that went down 40% is presenting you with an opportunity of, let's say, 250%. So you sell the other stocks, let's say they were also trading at $1, and you think they will be worth, or they are worth $2, and they will get there someday when the market is a weighing machine. So you sell the 100% expected returns, nibble a bit or sell a few shares of, let's say 19 of them, and you add in the one that you think now is presenting a 250% return on your money. You just created future money. That portfolio will actually do better than if all your stocks that you bought for $1 and you think they are worth $2. Here's what you think your 20 stocks are worth and will trade at sometime in the future. You bought them all for $1. The expected return on your portfolio is 100% sometime in the future. But you have one stock that went down to 60 cents. But you think nothing has changed. You might think, hey, that it was a fund that got liquidated. Somebody had to sell. Somebody needed money. Somebody's losing money on some other place. Somebody's got to pay their mortgage. There's a million reasons for people to sell and only one to buy, as they say about, insider buying and selling. So let's say Joe Schmo needed money to pay his mortgage because pay his whatever the interest on his mortgage because rates have been going up, as many people might be aware. So he sold it because he needed to, and wasn't enough buyers. Nobody cares in this sector. There was not enough buyers to keep the price fair. So he just dumped stock, overwhelmed the buyers because he needed the money ASAP, and all of a sudden, well, let's pull it down to let's say 250 or whatever. So now all the other stocks, they are still, let's say, trading at $1 when, I don't know, 6 months have passed. But this one stock went down to, let's say, 60 cents. 1 second. So 19 stocks were flat. One stock where Joe Schmo had to sell because he needed money, or a fund, Joe Schmo fund, needed to raise cash because obviously bad investors, which is 95% of people, they think this is a time to sell because they're looking in hindsight. They are investing backwards in time, while this is absolutely irrelevant. The only thing that matters is the price we're paying today versus the actual value or the future value will be. So the worse the past, the brighter the future. But everybody forgets that, of course, because nobody can invest. So this curse that, hey, this stock fell 40%, if you sold some of the other 19 stocks for $1 a stock each, and you sold 100% opportunity, meaning that what you sold you expect to make 100% from, but the money you raised from selling these, giving away 100% opportunity, you bought a 240% opportunity. Of course, that is making the expected future returns of your portfolio better. If you do the right thing. If you do like most, well, I sell this because it's not been performing and buy more of this. Then you're eroding the future returns because you just took a paper loss, turned it into a permanent loss by selling out and bought worse opportunities. So you're not even gonna get the double in your portfolio because you sold with a 40% loss and you couldn't even buy back the as many shares as you started off with, if you know what I mean. So you decreased your dry powder and put it into opportunities that was worse than in the stock you sold. But if you do it right, if you understand that this market is extremely volatile and it is the volatility that is the whole point how you can make money. We should be loving these times, obviously, because you'll never find higher future returns than when this sector is absolutely in the dumpsters. The future expected returns from these lows are they don't get higher. This is the highest future returns. The dry powder here is the highest expected returns since 2008. 8 years. So money invested here had a 625% return. Money invested up here had 247. So again, there's a big difference between buying, selling, and holding, and you can always, thanks to volatility, thanks to people panic selling, you can continuously upgrade your future expected returns. If you have a firm grasp of what you think the value is, and you understand that volatility is something to be used and not abused by, and you know that most people sell the cheapest stock because it's become cheap, because price has gone down, and then they buy stuff that's already maybe up here, whatever, and or maybe up here because this is sure 100% in a bull market. At this point, this is 100% in a bull market. Everybody can see it's a bull market. So they sell what's gone down. Here, let's say, go into another sector that's been in a bull market. You should obviously do the opposite. So in this case, now if you did that you realized this was unwarranted, unjustifiably cheap, cheaper than the stocks you already own, you sell some, no dry powder used, you just converted some of your holdings to cash, to dry powder, and jumped immediately on an even better opportunity with that cash. So maybe instead of your original portfolio doubling, instead maybe you'll make 110%, more than doubling. So without any additional money put in the sector, your portfolio will be 10% more valuable when the market becomes a weighing machine. If there was no volatility, this sector would suck. It would be extremely hard to make a lot of money if this sector was always in a nice looking uptrend. And every single stock moved like this. It's a good thing that stocks are extremely volatile, go up and down when nothing changes. Maybe value is going like this, but you can see stocks go something like this. Maybe another stock more goes like this. So let's say both have similar value curves. They're creating value at the similar pace, which is this line here, which we will put in pink, no, green actually. So this is the value line, and here you have two stocks that are growing. They started off, let's say they started off same price level, or same cheap level, price to value level. But you can see, depending on what people do, prices move in. Here, maybe your schmo had to sell. Here, somebody got FOMO in the other stock. Here, somebody, this started to rise. Here, people got FOMO because they saw the price go up, so they pushed it higher. Theoretically, you could, of course, create a lot of future returns by simply, in this case, selling this one, buying that. Let's say you sell 30% of this, your holdings in this, use all that money to put in this one. That goes up, you have a bigger position, big rise. All of a sudden this one is cheaper than this one, so you sell maybe 50% of this one, get it into this one instead, because future expected returns are higher. It's trading below value, this is trading above fair value, etc., etc. You could do that forever thanks to volatility, because this sector is anything but rational. And if you believe the bullshit prices that are out there right now, that's why I'm not worried at all. That's why I can go on vacation. I know I'm gonna win, because I think that every single stock I own is cheap. I expect, even though I know I won't make money on every single stock, but they are so cheap that, like I showed with the gambler portfolio, this portfolio is obviously done well in such short amount of time, 1 month and maybe, what's that, like 2 weeks, 1.5 months. if you would compound 36% every 1.5 month, you would obviously be richer than Warren Buffett in, like, I don't know, 5 years or whatever. So this is, I was going to say, unsustainable. But the thing is that, yes, it is unsustainable, but those are the kind of ridiculous returns you get from these levels. The problem is that no market goes up forever and goes down forever. So from these levels, the future expected returns are absolutely absurd. Absolutely absurd. Problem is that one day they won't be this cheap again. One day will be much closer to a top than a bottom. One day they will be overvalued, so the expected future returns are negative. That's why you can't just look at something like this and say, oh, okay, you know, at this pace, that's why, you know, obviously why people piled into Dogecoin and Bitcoin and everything like that at every top, because they think that it could keep on doing that run forever. And for crypto, for example, nobody even has a faintest idea what the value actually is. In this case, yes, we can actually have some sense of value. If we know the net present value according to a feasibility study is $1 billion for a mine and is trading for $2 billion. I mean, you shouldn't need a rocket scientist to, you don't need to be a rocket scientist to appreciate that, hey, I'm not buying cheap, that's for sure. Yeah, it's forever cyclical. So that's, I guess, the copium for today. This is one of the hodl portfolios I manage. I mean, this is not a return that many people might think looks sexy at all or whatever, but it's like, yeah, GDXJ has done minus 33% over the same time period. So this is beating GDXJ by 100%. That is some serious outperformance. And again, it's like, yeah, of course I would be happy or would want even higher returns. 3 years, 70%. Then you can start to think like, well, 70% per 3 years. Well, it's going to take forever to get rich from that. Yeah, but the thing is, these 70% happened in this market. When this sector gets going again, you can throw this kind of pace of, you know, return pace out the window. This portfolio might be up 300% in 6 months, all of a sudden. That's the crazy stuff we can see in this sector. We're nowhere close to the sector being overvalued. It's not even fair value. I mean, again, it's like, in my opinion, like the returns, my estimated value ranges before. I think, you know, a bunch of high risk, high reward stocks, even though, yeah, we don't know what the chance of success is, but I think even if you have a modest chance of success, like 5-10%, or in some cases 20-30%, I think they're undervalued by like 300% on average. And of course, the ones that actually do end up working out, I mean, who knows where, you know, am I going to be surprised if Headwater becomes a 5 to 10 bagger? No, I wouldn't be too surprised of that in a year or two. That would pay for half the other stocks in this portfolio. Tectonic, I mean, hey, if that becomes a half a Donlin Creek or whatever, probably could pay for every single company in here alone, if every single other case went to zero. Inflection Resources, if they make a copper gold discovery in one or more in New South Wales, could probably pay for half or more, maybe all of the other companies. Brixton Mills, if they confirm, you know, Trapper or Camp Creek, whatever. But the thing is, every single thing, all these cases need time to play out. Tectonic cannot prove up a half a Donlin Creek tomorrow. That's the thing. So in order for this strategy, this diversified high risk reward portfolio to work out, it means you need time. I have no idea if this portfolio is going to be up or down today or tomorrow or next week. In 2 years from now, I think there will be a few big successes in this portfolio, and this will be a multi-bagging portfolio. But you cannot. They have to have the time to do the work to prove that they have what we hope they have. So time and waiting is like the essential thing. Because again, I have no idea where Joe Schmo is going to have any of these stocks trade today or tomorrow. Maybe tomorrow, one or two of these stocks, maybe somebody needs to sell to pay off a mortgage. Maybe somebody almost got bankrupt. Whatever. You can see a flush at any point in time. Has nothing to do with the company. Has everything to do with somebody perhaps needing to sell or get scared and sells. But fast forward 20 news releases in each of these companies. The ones that work out will have 20 news releases of not net positive results. And they will not be trading at these levels when that happens. But they cannot do 20 news releases worth of work next week or next month. Maybe not even within the next 12 months. So again, a strategy has to make sense. I can make a high risk, high reward strategy and say that, hey, I think every single stock in here has 10 bagger potential or more, and then wait a month, and if it's down, it's like, oh, it didn't work. I don't think a single company in here has actually even produced one assay yet from this field season. Obviously, it's going to take probably 1 or 2 field seasons worth of work to show if they have what I hope they have. That's the whole strategy. Otherwise, if you put a time limit on next week or next month or whatever, that's not a strategy. That doesn't make any sense at all. Which one of these can 5 bag or 10 bag the value of the company without a news release? None. Took Great Bear 3 years to show that they have 6 million ounces. 3 years worth of news releases. And if you held that one, it paid for 20 other equally weighted cases that went to zero. But Great Bear didn't pay for shit if you gave it 1 month or 1 week or 1 day. There's no way that they could go from a discovery hole to blue sky within a week or a month. Not even 6 months, given the nature of that system. There are few cases in here which could. It's like the standout is, of course, what would that be? Condor, for example. Yes, that company actually perhaps can kind of go from almost zero to blue sky being confirmed within 1 news release, 1 drill campaign. Other than that, most of these need to do many holes, many news releases, perhaps a couple of field seasons in order for blue sky to materialize if it's there. So it's a kind of a case by case. I mean, if you're in a company that you know needs 3 years for blue sky to be evident if it's there, you need to give that story 3 years. If I had 20 different Condor resources, this portfolio could play itself out within the next 6 months, because that's when hopefully Condor will have drilled and have assays within 6 months. And they will be able to show what's there in 6 months, let's say. So if you have 20 cases like that, the whole strategy of this gambler portfolio, if there were 20 different Condor resources in this portfolio will have been played out in let's say 6 months. Because in 6 months, every single one hopefully will have reported. Maybe a few will have found what they're looking for. They might be up 5 to 10 times, and you know the case is kind of over. Yes, blue sky happened, or they found something close to blue sky or whatever. You're up hundreds of percent, and from there on, it's like yeah, the discovery drill play story is over. They went from 0 to maybe 6 million ounces, and you know that's probably it. What they have, 6 million ounces. So you've already reached the end of the growth potential in 6 months. If they had a success, you got paid in 6 months, and then it's over, and you liquidate, let's say, every single position. Let's say 15 of them went, or 10 of them went down 50%. They didn't hit what they hoped for. 10 of them or 5 of them hit something pretty good. You're up 300% on them. They paid for the other perhaps 10 already, and then you know 5 of them actually hit kind of close to blue sky. They're up 10 to 15 times. Preferably, obviously, from a compounding perspective, if there are cases like that, if there were like 20 Condor resources every 6 months, that would be the dream, but that's unfortunately not the case, because most targets are not like that. There are not too many good high sulfidation targets out there. I mean, the closest ones right now to that kind of thing is like porphyry exploration, perhaps like Inflection Resources. I would kind of say Altamira also with their porphyry gold target, kind of snowline type. We have Cartier, which is also drilling into a disseminated system, or what is believed. Rakla, obviously a snowline type potential. That hey, if there's something there, that might be, we might have a good clue of just how much there is there within this field season. Pacific Ridge, if they make another discovery. Tectonic Metals, obviously, if they put out some broad space deep holes, and I mean a lot of them hit, that will quantum leap their value. But every single case is different, and every single case is have different price levels, etc., etc. Well, they're priced differently. So I mean, obviously, if you had one Condor resource at 100 million and one Condor at 70 million and one at 50, the 50 million Condor would obviously be much better than the 70 or 100 because it's simply cheaper. So you're getting better odds, you're getting more reward in case it turns out favorably, and the odds wouldn't even be different because none of the 3 different Condors would have been drilling yet. So it's just from a risk-reward perspective, the 50 million market cap Condor would be superior by definition because price is less chance of success is priced in. It will go up more than the other 2 if all 3 prove up the same thing. And it's like this is just a draft, but it's like the big long commodities. I mean, there's so much. So many nice articles and shorts, etc. to shows. I mean, I'm almost bullish on any single commodity, and yes, even though I don't really believe that much in the green revolution, from the sense that I don't think wind turbines and the current versions, at least, of electric vehicles are sustainable. But I mean, like somebody said, even without the EV revolution, I mean, stocks of copper, zinc, nickel, I mean, they're going down regardless. Because we're not making enough discoveries. So it's like, that's what I really like. I mean, lithium is kind of, I shouldn't say dangerous, but it's like, if the EV revolution keeps on plowing and we're gonna need the amount of lithium that people believe, lithium prices could go much higher. But still, it's like kind of tied to batteries and electric vehicles, etc. But it's like nickel. The biggest usage for nickel is in stainless steel. I mean, regardless of if we make cars with electric with batteries or hydrocarbons, internal combustion engines. I mean, you're gonna need nickel for the steel, and you're gonna need zinc for the steel, and all of that stuff. So I just think it's an absolute no-brainer. I mean, the most commodities are no-brainers, especially if you have the critical elements in places where, like in Europe, for example. I read an article yesterday that CEO of Renault, or whatever you call that car company, he was quoted as saying like, the metal situation keeps me up at night. In the wake of China banning, I think they banned the export of some rare earths. So I mean, you would probably want to find a critical mineral deposit somewhere in, Europe, for example, because that's a competitive advantage in a sense. I mean, if you own and find nickel in Indonesia or whatever, they have way more nickel than they need, and the Chinese are buying everything. But if the Europeans we definitely need our own mines in Europe, because the world is getting sketchier and our relationship with the US is even going downhill. That's quite a competitive advantage. I mean, there's got to be a lot of forces that wants to see that mine in particular come to life. So maybe there'll be free money, grants. I mean, they're handing out grants in North America already for critical minerals. And again, I don't think that's going away anytime soon. And even if one day the EV revolution takes a hit, I just don't see. I simply don't see a big problem. We're still gonna need much more copper because the world economy grows at like 3%. I mean, nickel, LME's been a bear market in terms of supplies for the last 5 years. So I don't worry about a lot of things right now, except for the world going to absolute shit. But that's also why I love gold and silver, obviously, and especially I think it's time for me to get some more physical gold and silver, and all of that. But no, I mean, it's like a no-brainer. Commodities are no-brainers. The miners, the prices of miners, the price you can buy these metals in the ground in good jurisdictions, absolutely sensational no-brainer. It's not even pricing in any kind of shortage. It's not even pricing in these charts here. It's not even pricing in the EV revolution continuing. It's not even pricing in the fact that the West, more than the East, needs to secure their own sources of metal. So it's just a no-brainer inception. No-brainer within a no-brainer. So it's like, I have no problem going on a vacation. I don't need to look at the price. If I think my average junior is 300% undervalued, okay, so on average then, I have to wait until they go up like 300% before I need to make decisions. Before I need to find something else, before the opportunity is gone. And yes, you can be a perfectionist, obviously. Let's say a company goes up 40% and you can find something that's not gone up 40%, like I talked about here. You can do that stuff as well. But even without perfection, there's no real problem. I think every single stock I own pretty much is dirt cheap based on its potential or what they already have. And yes, if you want to be more active, you could pay attention to the micro moves in different ones. Like, okay, if I was on a vacation, maybe my portfolio would have done like this. If I was, let's say, more active and conscious of the different swings, and there was enough liquidity that I could value trade maybe, and I was a bit active, maybe the future or the portfolio would instead perform something like that. But it's like, hey, if I don't do any trading and I expect to make 300% in my portfolio from here, that's great. That's nothing to complain about at all. If I expect 300% from here or more, superb. It's like, yeah, you could wait many years and be happy with 300%. If you were more active and did value shuffling and just use as much dry powder you could to buy the cheapest stock at any given point in time, yeah, you might end up making 340%, and you would have more money put in, so you make 340% on more money as well. So that's, kind of a compounding in a sense, that you're both using volatility and abusing the ones that get abused by volatility, and you not sell and not hold, but buy cheap as long as they're cheap, and just continue to buy as long as the future returns are high. You just continue to buy. You right here, you might or a week ago, your cheapest favorite company might you think it might have a, I don't know, 300% expected future return. Maybe it's jumped up a bit and you get some money, so now it's down to 270% future expected return. That's still great, even though yes, it would obviously be better if you get $500 to invest and you could put it in a company that you think needs to go up 300% to fair value than 270%, but 270% is still absolutely great. So it's like you don't even need perfection, nowhere near perfection. People think that beating the market is so hard, and you need to follow I don't know how many newsletters, and you have to keep up with what the COT report is suggesting, what the Fed is going to do, and all of that shit. I don't pay attention to any of that. I haven't watched a single FOMC meeting that I remember. I don't even know what the rates are in the US right now. I don't know what the Fed funds rate is right now. I don't care about any of that. I only care about what I think a company is worth right now or might be worth in the future. And then I look at the price. What is the dipshit dumb Mr. Market selling this future that I see, or the current and future that I see? Oh, it's selling for 30 cents on the dollar. That's all I need to know. That's a no-brainer buy to me. I don't need to know what the Fed funds rate. It's not like, oh, it's selling for 30 cents on the dollar, but I also need to know what the Fed is doing. Or I need to know that the wind is blowing from east. Or I need to know that inflation has gone up 0.2%. And I need to know that the COT report is exactly whatever. Good luck making decisions. Like Mr. Napoleon said, in war the simplest maneuvers are the best. Buy cheap. Now it's cheap. Buy cheap, buy cheap. Sell high, sell expensive. That's all you need. It's just ridiculous. The amount of things we try right now. We try to, goddamn. I mean, the prices are absolutely ridiculous out there. And of course, people will find an excuse to sell. It's like, whatever. I'm trying to come up with some stuff like, hey, there's no guarantee that this is going to work, so I'm not buying until it's a guarantee that it will work. Well, go and buy the perfect case with no uncertainty, and you'll pay a hefty sum for it, and you're gonna lose your shirt most probably. We're not after certainties. We're after favorable probabilities or favorable risk reward. A case can have a 10% chance of success, and it could still be a super buy, and you can have because it's pricing in a 2% chance of success, and you can still have a case that looks so good that it's like, yeah, there's 80% chance that this is going to hit blue sky or whatever, and it's pricing in a 90% chance of blue sky. That's a sell. Even though the former has only a 10% chance of success and the latter has 80% chance of success. The only thing that matters is what price are we paying for said futures, etc., and for the probabilities. Now this is an absolute no-brainer. It's like I don't think I need to do a single trade And same goes for like, yeah, this portfolio. I mean, that's the whole reason I made this. Is like I'm gonna see. Let's say, I don't know. Maybe I don't know when actually the bull is gonna. When the big bull is gonna kick off, and I don't know exactly how long it will take for each single case to, prove up blue sky if it's there. But it's like within 2 years, without a single trade from here, I believe this portfolio will have multi-bagged. Even if I had a stroke, or if I didn't do a single thing, not a single trade. I can't come up with a more high quality of life approach than actually it's like, I can go on vacation for 2 years and come back, and I think I will have made more money than it costs to travel the world for 2 years, or something like that. You cannot, if you're a plumber, you cannot take a vacation for 2 years and get paid for being a plumber. In investing, you could actually have better returns the less you do. Because if for example, if we knew that it would take 2 years for all these cases to play out, the only thing you kind of need to do is do nothing for 2 years. The ones that become successes will be up hundreds of percent. The ones that fail will be down 50% or more. If we go into a gold bull, that's the thing, we have this as a tailwind. We have all of this left, regardless of what the actual companies do. Same success for these companies will be priced orders of magnitude difference with sentiment here relative to here. If any of these companies have success X, and success X is priced at Y down here, same success, same news flow. When we are at these sentiment levels, maybe that same success will be priced at Y times 3. So this is all in store for us. This sentiment revaluation, this sentiment boost, which can be hundreds of percent, is in our back pocket. This is an option with no expiry, because we know it's going to happen. So I don't think many people, unless you've been in this sector and seen it and know how it works, I don't think people know what's in store for them in the coming years. Because again, if you've only seen this period to here, you think that's how this sector works. What you're seeing now is, you think that's how it always worked. That's not the case. That's absolutely not the case. This sector has some of the most violent, irrational rallies you'll ever see. And of course, the rallies get more irrational and violent the longer the trend has persisted. Same with the crashes. Well, this started off quite well already, but this is just whoop right down in the cellar. And here you have an uptrend has started. Then all of a sudden, bam. Okay, consolidation, but it's still, uptrend. People are seeing it, people are hearing about it, then boom. And this, of course, is just absolutely insane. It's like, here probably other people started to find out about this sector, and that additional dumb money getting in after, when they believe it's a bull market, then they start to get in. Here they were obviously convinced this was a bull market. And here they were maximum convinced that this was a bear market. Same here. Here everybody and their mother sees that this is a bear market. So nobody and their mother believes it's time to buy. So we're waiting for a bottom to be in place. I personally think we probably have hit the bottom. But the real fireworks will come when the trend up is obvious to people, and we're not even close there. People are still pissing on gold miners and silver and metals overall. So it's like, I think most people don't even believe we're in a bull market. So that's how early we are. Ways to go. Thanks for listening. Bye.